Hello everyone, how's it going? So in this video, we're going to be talking about Mullen. We're going to update on how the company is doing, where it's heading towards, and what's next for us, the traders. The company is in EV manufacturing, distribution, and marketing. It acts as a holding for many brands and companies that they may have purchased all along the way. The latest example includes Elms and its EV trucks. So Mullen actually has a very lengthy history, which is a good news. The company began in 2014 as a successor of Coda Automotive. There was another company called Mullen Motorcars that has founded Mullen GT, which was one of the earliest EV supercars in the market back in 2007. So overall, it's fairly convincing for us to say that Mullen is an EV veteran. So at least we can, rest assured that they have been around the block for sufficiently long time to know what they're doing for the most part. The question is whether they have the means to continue the long game. Because yes, the EV sector is a long game. They require a large amount of capital to succeed. At the moment, people's adoption is increasing, but is it increasing enough for the shareholders to wait till they start to have operating cash flows? This is a real question. I think that for some companies they have succeeded doing so, and even then it was in extremis. So the example here would be Tesla and even NIO before. For Mullen, I would say that on a number of occasions it was not enough for them. We were talking about how they had previous ventures. They were one of the earliest players in the sector, so on and so forth. But ultimately, the fact that we are where we are today, meaning one of the later avatars of Mullen, without the company doing so well, is kind of a testament of what I'm saying here. Maybe they're just running out of money, right? And going forward, this problem is probably going to continue to be an issue. So the recent price action showed a huge spike in the share price due to the distribution right for iGo in Europe, which may finally bring in some much needed cash flows for the company. Because keep in mind that this company, for about a year, if not more, no longer have a penny in revenue. So this part is a bit worrisome because meanwhile, their expenses continue to incur. I'm not saying that they're increasing at a very alarming pace either, but they still have expenses, right? So this means that they're slowly digging themselves into a cash flow hole. Now, there's also another element that we are going to talk about afterwards, is the short squeeze. There's a huge amount of short positions that are betting Mullen to go lower, and if a short squeeze can occur, then there can be a significant upward potential. So overall, the company has been having a mostly bearish trend over the past 5 years because it was trading between $5 to $10 for 2 to 3 years before peaking around $15 in the 2020, 2021, 2022, these 3 years era, before finally falling to around a penny stock level in recent months. Online communities and most media outlets are kind of skeptical about Mullen and its capacity to turn a profit. They're also pretty uncomfortable with the periodic lack of transparency from the governance, not disclosing who are their key commercial partners, the clients, or things like that, things that are significant for people to put trust into their company. They have kind of given us a bait, and they try to say that, okay, you know what, don't worry, we have, legit partners. But who are the partners? They never say it. Or we have big clients coming in, but who are the clients? They never say it. That this kind of stuff, in my opinion, would hurt Mullen's fortune in the long term if they don't change this attitude. So overall, Mullen does give people the impression that a company is good for trading, but it's not so good for long-term holding and investment. this has been one of those realities that we have to deal with. Um, the trends within the EV sector and the growth stocks in general, on the other hand, are also under pressure due to the increasing interest rates, the capital flight, the conflicts around the world, and the bearish expectation for a long overdue recession. And also, keep in mind that over the past, from '08 to nowadays, so over the past 14 years, securities around the world have mostly lived off newly printed capital. But we have to remember that at the end of the day, capital in this form is just printed paper, right? It's a number printed on a piece of paper saying it has value. And the reason why we haven't felt like hyperinflation in the real economy over the past decade or so is because this capital went into the financial system. This is why like the equities and so on were going through the roof for more than a decade. And this is what got people unsettled by like 2018, 2019. And also the reason why I think that this fear for prolonged recession is more than justified. And also is another like cycle of bulls coming back and save the market with newly printed capital. Is it going to work? Is it going to occur? So far, it's really difficult to say. I'm not sure that those who have the capacity to do it can necessarily come in and make this decision because it'll have consequences in other parts of the economy. The additional concerns would include like issues like supply chains, shortage of advanced microchips, the valuation model of EV companies. If it switches from being valued like a tech company to a car manufacturer, this could potentially reduce dramatically its market cap. Same goes for every single company across the board, including Mullen. Another reason why Mullen has been an interesting stock to follow, though, because, so far we've been talking about the problems, we also should talk about what makes it interesting. It doesn't always follow the trend. It hedges some of the sector-wide risks. Okay? It does do that. So, the cash balance for Mullen has been increasing year on year, but it decreased somewhat in recent months from 105 million to 84 million. So overall, as far as cash is concerned, I don't think that it's a big issue. It's also giving us like an indication that they don't have to dilute the shareholders immediately, which is also a good news. But like we said before, the company is not pulling a net profit, or it's not pulling any revenue at all at this period of time. Hopefully it's going to change with the distribution deal of IGO in Europe. But for now, like, this situation is worrisome indeed. So seeing that they still have cash balance, it just means that we will have another few months ahead of us to hopefully see the situation change and to stop worrying about like whether they will have enough money in their coffers to fulfill their short-term and immediate-term obligations. For example, if a company cannot pay the loan interest that it is due, the company would be considered as insolvent, and then liquidation may occur. Okay, so this is something that we absolutely have to watch out. Speaking of which, in terms of its liabilities, and to be more specific, the current liabilities, they've been increasing at a relatively steady pace over the past 3 quarters. In by itself, I would say that this is something that we have to watch closely because it may suggest that it could have like a going concern risk if this kind of debt situation keeps piling up, and it'll indirectly increase the cash flow pressures as well. Now, the profitability, like we said before, there is no revenue since the beginning of 2021. Research and development has been increasing significantly in the recent month, with the general expenses down. So overall, it's a good sign. But the operating losses will keep digging holes into the company's finances, which will eventually either force the company to take on more debt, which is never good, or to force the company to dilute the shareholders, which is also not very good. So the whole situation is relatively awkward for Mullen, which can hopefully be alleviated partially with the iGo distribution contract. Overall, the financials of Mullen shows us that the big picture of the company, and it's doing its best to stay afloat, to control its cash levels and to keep the expenses low, or at least as low as possible. Because if we look at the financials, like over a period of a year or two, I wouldn't say that they are very good at keeping their expenses, lower as time goes. It seems to be a lot more jagged. But still, the positive cash flows need to happen to avoid dilutions. Like regardless of what we can say about the current finances, they don't have revenues, they need to have revenues. Otherwise, money would have to come from elsewhere, either raising capital through equity or raising capital through debt, neither of which Mullen has a lot of room to maneuver for. And if things don't improve very soon, there could also be an issue for delisting from Nasdaq and be traded as an OTC, which is going to be even more of a challenge. But then again, I mean, Mullen currently has barely any institutional shareholders. So in my opinion, this shouldn't be a huge issue going forward. Of course, recently I've heard that apparently one of the larger banks on a main street has decided to buy like a small position in Mullen, so it's certainly encouraging. But I honestly don't think that this is going to change the overall mood that surrounds Mullen at the moment. Things need to improve, or, and this is what we're going to talk about in a bit, the mechanical short squeeze needs to happen. These are the plays, in my opinion. So the clientele of Mullen are currently separated in two kinds. The first one is similar to Tesla, to NIO, to Lucid, and so on, which is the medium and high-end clients, because their cars are kind of, priced at that range. They also have lines that are designed for commercial and freelance businesses. So, these would be the iGo clients. And time will tell how many of these the company will have. So, iGo apparently is perfect for delivering parcels and food deliveries. And because they're small, they're compact, they don't consume a lot of fuel. It does seem to be. Oh, and also they just cost 12k euros. Okay, so it's a cheap car, it's a small car, it's a car that's EV. So all of these would mean that within European cities, people can deliver food and parcels with relative ease. So this is also like an interesting standpoint, especially when we know that for a lot of like Uber drivers, they would buy EV cars as well, because over time, or at least hybrid cars, because over time those technologies allowed vehicles to become a lot cheaper in those categories. And if they can also save fuel, then all the better. So overall, Mullen is still like an interesting mix of low and high-end products. So in terms of the shareholder description, shareholders are mostly retail as far as Mullen is concerned, which means that they tend to be volatile, reactive, and very quick at buying in or selling out stocks. But at the same time, the fact that we don't have a lot of significant institutional participation means that there isn't much trust from the institutional sides, or at least not as much as I would like to see for me to personally investing in this company for the long term. Okay, for the moment, I don't think that there is enough. And I will suspect that for some of these like institutional shareholders, they're here, but they're here as like short positions. You know what I mean? Like these seem to be like borrowed shares from brokers, and then they've already dumped it in the open market. They just need to pay it back eventually. Now, the other like macro risk factors would include like the increasing interest rates, the VIX being still relatively high, a tightening money supply around the world. We still have to see what's going to happen with this, but in my opinion, the days of everyone just prints money will either not come back ever, or will only come back in a like 12 to 24 months when things start to really look bad, right? This is when people would be like, oh, okay, you know what? It's okay to pour like 50 gallons of water in the soup so that everyone has something to drink instead of everyone just starving to death, okay? So until then, we have to deal with a tightening money supply situation. The conflicts around the world is also not helping, but then again, I would say that it's not helping indirectly. It's kind of proving the point of EV sector's relevance, funny enough. The supply issues that we've mentioned, and also how much time does a company like Mullen, so a penny stock with mostly retail shareholders, how much time can they really afford to have? Okay, this is also going to be an issue going forward. Maybe the shareholders could lose faith in Mullen's future, because keep in mind that the fact that a lot of people are buying Mullen is because they're hoping for a short squeeze, and like a significant one at that. If there is none, then the future dims somewhat, okay? And by dimming, maybe all the way down. So if we briefly compare like the pros and the cons of Mullen versus other bigger EV companies, one of them is that it doesn't seem to be market correlated. It doesn't always correlate with how the market trends are. Of course, when the markets are bad, Mullen also tends to dive to new lows, but it doesn't always do that. So in that sense, it's an interesting stock to at least consider. In terms of the cons, I think that the biggest con for Mullen is the lack of a long-term perspective and the worries of cash flow problems, because the company is not making money at the moment. And I don't know how it's going to go if Mullen decides to dilute the shareholders even more. So with all that being said, the other actual huge catalyst for like to explain why people decide to pile in Mullen is because when they saw the distribution contract, they collectively decided to say, oh, you know what? There might be a short squeeze, because while we're at it, it seems like Mullen has a huge amount of short positions going on. Short positions, like those people who have short positions open, they have to pay financial fees to the brokers as long as those positions are open. So the longer it takes, the more it's going to cost them, and the less they're going to make. But that's not all. If they see that the stock price goes up and they no longer have enough allocation in their capital to push the stock down even further, okay, they would have to redeem their positions to avoid heavy losses. Because here's the thing regarding short squeeze, or at least like short positions. If you think that a stock will go down, the potential profit is whatever the price is and zero, like between whatever the price is now and zero. But the potential loss is whatever the price is and infinity. So this is why I would say that it's always a risky move to like proceed to short positions to a company. And this is why if Mullen's price increases at some point, a lot of those short players would have to like redeem their positions, which will act as a second push to the stock. So with all that being said, my recommendation is that if you have a lot of diversified holdings, if you're willing to take risks, you believe the long-term relevance of EV as a sector, And if you believe that the upcoming fundamentals for Mullen are going to be positive, and if you believe in the short squeeze, then definitely buy now. Now, no one can tell you with certainty how far it could go down or how far like the retracements or the pullbacks are going to happen. But let's assume that it could test its new low, like the recent new low, sometime in the future. I frankly no idea whether that's going to happen, and I don't wish for it to happen. But we have to prepare for this scenario, okay? Now, the upside, of course, is huge. If a short squeeze does happen, we can easily expect like 100%, 200%, 300% plus profit margin on that trade. The exposure I would recommend would be around 0.5 to 1% of your portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.